Utilizing our fundamentals analyzer software tool FastGraphs, we're going to examine the earnings price relationship and the effect that valuation has on long-term shareholder returns on 4 specialty coffee companies, starting with Green Mountain Coffee Roasters, which is a $7.9 billion company. And what we're going to look at here, we're going to look at the earnings per share, which is the orange line on the graph, utilizing a PEG ratio calculation for fair value. And as you can see, Green Mountain Coffee Roasters has grown earnings at 37.2% ever since 1997. We're going to only go back a maximum of 15 years. What you see here is that we have a very strong correlation between earnings and price for most of this time, and then we had this huge acceleration in earnings growth, starting around 2007 or so, that also led to this huge price increase in Green Mountain Coffee Roasters before the price subsequently and recently fell, from a high here of over $100 a share to its approximate $50, $51 share price that it currently trades at. Our next example, we're going to look at Coffee Holding Company, which has a shorter history as a public company. And as you can see here, we've got some relatively inconsistent earnings growth. However, for the last 3 or 4 years, we've had some strong earnings growth. So in their 7-year history, this company has averaged just under 17% earnings growth. But you can see, based on some really exceptional earnings growth during these last couple of years here, that the stock price got very high relative to its historical norms. Our next example is going to look at Peet's Coffee, which goes back to 2001 as a public company. And you can see some very interesting earnings growth here, almost 26% a year. And you can also notice that the market has typically overpriced this stock. But I do want to point out how when valuations got kind of extended like they did here in July of 2005, how stock price actually went down several years, especially after earnings fell a little bit. But then we've had this reacceleration in earnings growth, which has led to a very strong rise in stock price. But I do want to point out that, with a current PE of 38 times earnings, 37.9 times earnings, we're going to make a case that this company is probably overvalued today, even though their earnings growth has averaged about 26% a year. And then finally, we're going to look at the 800-pound gorilla in this class of stocks, Starbucks. And as you can see, Starbucks, going all the way back to 1997, had some really excellent earnings growth, and the market had historically placed a premium on their shares. But we do want to point out and have you notice that once we got kind of an extended valuation, during this 2006, 2004 era here, what a major effect it had on shareholder returns. As you can see, stock price fell dramatically, especially when there was finally a kink in the armor here when Starbucks showed their first decline in earnings. Even though the company was very profitable, stock prices fell from a high of 37 all the way down to under $10 a share. But then once they kind of started accelerating again, you can see that stock price followed that. And I would point out that a couple of years ago, Starbucks started paying a dividend. They currently yield 1.2%. But their 15-year growth rate in earnings has averaged 24.2%. The market has normally placed a high value, a 38.5 multiple, as you can see here on their share prices. But once there was this kink, we did find a situation where the price became undervalued. Now let's take a look at how all this marvelous earnings growth and these earnings records have translated into shareholder performance. We'll start with Green Mountain Coffee Roasters and look at their 15-year performance results going back from 12/31/1996. You can see that a $100,000 investment would have grown to over $22,780,000 during this time frame, all based on the fact that stock price, grew and accelerated with earnings. That's a 44% compounded rate of return, which is very consistent with a 37.2% earnings growth rate that the company achieved. Going to our next example for a shorter time frame, we see Coffee Holding Company that was, pretty highly priced on its initial public offering. It got, pretty extended, as companies tend to do, and then stock price, fell precipitously as earnings fell. And then as, the coffee industry got hot, you can see that stock price became pretty extended here by July of 2011, but a 16.7% earnings growth rate did calculate into about an 11.3% shareholder return, with some modest dividends thrown into the equation starting in calendar year 2008. We'll go to our next example now and look at Peet's Coffee, and you can see that price and earnings tracked very nicely here. I do want to again point out how valued the stock had become back in 2005 and what an effect that had for the next 4 or 5 years on shareholder returns. But in the long run here, since January 31st of 2001, a $100,000 investment would have grown to $490,000. That's a 15.9% rate of return during a period when the market actually lost money on a capital appreciation basis, but only generated a positive return thanks to dividends. I'm referring to the S&P 500 here. And then finally, we're going to look at Starbucks, which is a very interesting picture here, because as we look at Starbucks going back to 1997, we discovered that Starbucks had very excellent earnings, and the price stayed pretty high, you know, with the obvious volatility in between. But once we saw this chink in armor, we saw the price fall dramatically, as previously pointed out. Nevertheless, a $100,000 investment on December 31st, 1996 would have grown to $1,174,000 plus dollars. That's averaging an 18% rate of return during a period where the market averaged 4.8%. So the idea here that we're really trying to convey is how important earnings growth coupled with valuation actually turns out to be relative to shareholder returns. From here, we're only going to focus on the period since the Great Recession of 2008. And as we pointed out earlier, there was this huge acceleration in Green Mountain Coffee Roasters earnings growth, where since calendar year 2008, they've averaged almost, just over 89%. So a lot of the very strong, rise in price was really justified. However, this is using a PEG ratio valuation. This orange line in this example represents 89 times earnings. And as you can see, the company never traded at that high a rate. It averaged closer to 54 times earnings as a normal PE ratio, which is still extremely high. When you look at the track record, the company since the Great Recession or 12/31/2007 has averaged over 56%, almost 57% a year compounded. But now we'd like to turn our attention to the forecast. When you look at the company going forward, and we're going to shorten this this graph a little bit to only a 5-year graph, because the idea here is we want to focus on estimates that we consider to be most realistic. And what Fast Graphs does is it supplies next year's earnings estimate and then calculates earnings growth from that point based on the consensus of leading analysts. In the example of Green Mountain Coffee Roasters, there are 7 analysts reporting to Capital IQ expecting a 36.5% earnings growth rate going forward. After this huge correction we had in stock price, from the really high inflated valuations that had occurred as a result of such, that short-term period of just extraordinary earnings growth, we think this is a much more realistic picture of Green Mountain Coffee going forward. When it was once overvalued, you can see it clearly here in August and September of 2011, it has subsequently come back into a more reasonable value with a current PE of 30 plus, with a growth rate of 30 plus. Earnings and price are now more in line, which would represent a very attractive long-term earnings growth and shareholder return going forward, because valuations now make sense. When you look at Coffee Holding Company for that same period, you see the strong growth rate in earnings once again translated into a very strong shareholder return of 18.1% for the 4-year period. And currently we have a consensus estimate of analysts expecting a 30% growth rate. Now, I do want to point out there's only 3 analysts reporting to Capital IQ for this smaller cap company. But again, you can see the effects of valuation at 14 times earnings with a 30% earnings growth rate. This is probably a very attractively priced company. Even if it only achieved a 14 multiple or a market average multiple, today's $9.28 stock price could be worth something like $23 or $24 by the end of 2014. And if it traded at a PEG ratio valuation of 30 times earnings, you can see that the potential returns are extraordinary. In fact, it would average over 50% a year if it actually hit PEG ratio valuation. So these first 2 examples are examples of companies that were once overvalued perhaps, but then became undervalued. Our third example here is Peet's Coffee, and you can see today that it trades at a 38% PE or PE ratio of 37.9, It has an historical earnings growth rate since the Great Recession of 22%, 22.3%, and a very attractive rate of return to shareholders that's consistent with that earnings growth of about 18.6%. But when you look at the consensus of estimates going forward, you can see that next year's estimate is for $1.80 a share, and then growing at 20% a year thereafter. But all of that, leads us to conclude that this company is perhaps very extended at 37.8 times earnings, and perhaps what happened to Green Mountain Coffee Roasters as also could happen to Peet's Coffee here in the very near future. And then our final example was Starbucks, which has really been the category leader here. And as you can see, they started instituting a dividend, but at 27 times earnings with a 14% growth rate since the Great Recession, we would argue that Starbucks also represents an overvaluation situation. The rate of return on Starbucks has been very attractive since the Great Recession, averaging almost 20% a year, which is obviously significantly better than the market, which actually lost money during that period of time. But when we look at Starbucks going forward, because of its size, there are a lot more analysts, 22 analysts following it. We're looking at a 27 multiple coupled with a 17% growth rate, and we think that limits the long-term, capital appreciation potential. And we would argue that there's a very strong possibility that in the near term, at least, Starbucks could come back into a more realistic, valuation, maybe averaging something like 17 or 8%. 17 or 18 times earnings, and then it would be an attractive buy. It was probably the last time it was attractively priced was September of 2010, and even for the long-term investor, that would have been a great time to hold it. What we've tried to do here is show the effects that valuation, earnings growth, and how the market capitalizes earnings and how it ultimately makes those adjustments over time were reflected in looking at these four coffee companies. So maybe the precipitous drop in Green Mountain Coffee Roasters stock price during this period of time would be a wake-up call, especially to those that are holding Peet's Coffee and Starbucks.